Look around you for a moment. Everything you see, every building, every road, every store, every screen, every dollar you have ever touched, all of it runs on something you were never taught to understand: money. And here's the part that almost nobody realizes. Most of the money in this system does not actually exist. It is not printed. It is not stored. It is not backed by anything real. It is created out of nothing. Right now, as you are watching this, somewhere in the system, new money is being born, not by governments, not by taxpayers, not by workers, by banks. And once you see how this really works, you will never look at your paycheck the same way again, because the truth is uncomfortable. The truth is dangerous. The truth explains why you always feel behind, no matter how hard you try, no matter how careful you are, no matter how much you sacrifice. You're playing a game where the rules were written before you were born, and the house never loses. Think about this. When you hear the word bank, what do you imagine? A big building, vaults, stacks of cash, rows of safety deposit boxes, serious people in suits guarding your money. It feels solid. It feels secure. It feels real. But that image is mostly an illusion. Modern banks do not work the way you think they do. They are not warehouses for money. They are factories, money factories. And their main product is debt. Every time you take a loan, every time someone buys a house, every time a company borrows to expand, every time a student signs a student loan, new money appears, not because someone saved it, not because someone earned it, not because it existed before. It appears because a bank typed numbers into a computer. That is it. No truck delivering cash, no vault opening, no gold being moved, just keystrokes. And suddenly, there's more money in the system. On paper, but not in reality. This is where the story gets strange and uncomfortable and important. Let us go back for a moment. Imagine you walk into a bank. You ask for a loan. $100,000 for a house? The banker smiles. They check your credit. They check your income. They check your history. Then they say yes. You feel relieved. You think, they are lending me their money. They must already have it. They are giving me something that already exists. But that is not what happens. Not even close. The bank does not go into a vault. They do not move stacks of cash. They do not transfer money from someone else's savings. They open a computer system. They create a new account. They type 100,000 and press enter. That number did not exist before. It exists now. Because they created it. You receive the money, you buy the house, you start paying the mortgage, and for the next 30 years, you work, you stress, you sacrifice, you worry, you give them back. Not just the 100,000, but much more. Interest, fees, penalties, adjustments, all paid with real labor, real time, real energy, real life. They created the money in seconds. You spend decades paying it back. This is not a metaphor. This is the actual system. And most people never realize it because no one teaches it. Schools do not teach it. Media does not explain it. Banks do not advertise it. Politicians do not discuss it. Because once you understand this, you start asking dangerous questions. Questions like, who controls the supply of money? Who benefits from debt? Who loses from inflation? Who really owns the economy? And who is just surviving inside it, right now? Almost all money you use is debt. It was born as a loan. It entered the system as someone's obligation, someone's burden, someone's future work. Think about how crazy that is. The foundation of modern life is built on promises to pay later, on IOUs, on chains that stretch into the future, and every year, more chains are added. More debt, more loans, more credit, more numbers, floating in databases, with no physical anchor, no natural limit, no real restraint, only confidence, only belief, only trust. As long as people believe in it, it works. As long as people keep paying, it continues. As long as people do not panic, the machine keeps running. But the moment that trust cracks, the moment people question it, the moment fear spreads, everything becomes unstable. Because the system is fragile. Even though it looks powerful, it is built on perception, not substance. Most people think, money is scarce. There's not enough. I must fight for every dollar. I must compete. I must struggle. But for banks, money is not scarce. It is unlimited. They create it when it is profitable. They restrict it when it is dangerous. They expand it when it benefits them. They tighten it when it protects them. You live inside cycles. They design them. Booms, busts, crashes, recoveries, bubbles, panics. These are not accidents. They are consequences of how money is created and who controls it. Right now, you are working in a system where the most powerful players can generate purchasing power from nothing, while you must trade your life for it, hour by hour, year by year. And the gap between those two realities is what defines modern inequality. This is why prices rise. This is why housing becomes unreachable. This is why savings feel pointless. This is why wages lag behind. This is why debt never disappears. It is not personal failure. It is structural design. And once you see it, you cannot unsee it. If banks can create money with a keyboard, then the next question becomes unavoidable. Who gave them that power and why? Because in most people's minds, creating money sounds like something only governments should do, something official, something controlled, something transparent, something accountable. But that is not how modern systems work. In most countries today, private banks create the majority of money, not the state, not the treasury, not the central bank. Private institutions whose goal is profit, not stability, not fairness, not long-term health, profit. This shift happened quietly over decades, through laws, through lobbying, through technical language, through policies nobody reads, through systems that sound boring, so people ignore them. And while people were busy surviving, the financial architecture was rewritten step by step until banks became money creators, not just money movers. Think about what that means. They do not just decide who gets loans, they decide who gets access to new money, who gets to buy first, who gets to invest early, who gets to benefit before prices rise, and who is forced to pay later, after inflation, after dilution, after devaluation. When new money enters the system, it does not land evenly, it does not fall from the sky. It flows through specific channels: banks, large corporations, governments, financial institutions, asset owners, investors, speculators. They receive it first, they spend it first, they invest it first, they benefit first. By the time it reaches workers, small businesses, families, renters, savers, the value is already reduced. Prices have adjusted, assets have inflated, opportunities have moved. This is called the Cantillon effect. But most people never hear that name. They just feel the result. Groceries get more expensive, rent goes up, homes become unreachable, healthcare costs explode, education becomes debt, and everyone is told, this is normal. This is just inflation. This is the economy. But inflation is not natural. It is engineered. It is the shadow of money creation. It is what happens when more claims chase the same real resources, when numbers grow faster than reality, when debt expands faster than production, when currency loses weight, slowly, quietly, relentlessly. Look at your grandparents' lives. One income, one job, one house, one family, retirement, security, stability. Now look at today. 2 incomes, multiple jobs, side hustles, debt, rent, uncertainty, anxiety. No safety net, no guarantee. Same country, same system, different rules. Because the money system changed, when money was tied to limits, to gold, to reserves, to physical constraints, expansion was slow, controlled, difficult. But once those limits were removed, once currencies became pure trust, pure credit, pure belief, the floodgates opened. Banks could lend far more than they held. Governments could spend far more than they earned. Central banks could intervene endlessly, and the consequences were pushed into the future. Onto you, onto your children, onto generations that did not consent. Every crisis, every bailout, every rescue, every stimulus, every emergency package, every temporary program creates more money, creates more debt, creates more distortion, and every time, the narrative is the same. We had no choice. It was necessary. It saved the system. But whose system? Who was saved? Who paid? After every crisis, the powerful become more powerful. Assets concentrate. Corporations merge. Banks grow. Regulations tighten on small players. Opportunities shrink. Freedom contracts. And ordinary people are told to adapt, to work harder, to be more responsible, to budget better, to sacrifice more, to accept less, while the structure remains untouched. Because touching it would mean admitting that the problem is not you. It is the design. It is the architecture. It is the way money enters existence. You were never supposed to understand this. You were supposed to believe money is neutral, that it just exists, that it flows naturally, that success is purely personal, that failure is personal too, that winners deserve it, that losers deserve it. That is how the system protects itself, by turning structure into morality, by turning design into destiny, by turning inequality into personal choice. And as long as people blame themselves, they never question the machine. When a system is built on endless debt, on endless expansion, on endless promises, one question always matters more than any other. What happens when it cannot grow anymore? Because growth is not optional in this system, it is required. If new money is not created, debts cannot be paid. If debts cannot be paid, banks collapse. If banks collapse, everything freezes. So the machine must keep expanding. No matter the cost, no matter the damage, no matter the long-term consequences, it must grow or it dies. That is why crises never fix the system. They only reset it, like pressing restart on a broken program. After every crash, after every panic, after every recession, the response is the same: more money, lower rates, more lending, more debt, more promises. The problem is never removed. It is postponed. And postponed problems become larger problems. Look at history. Every major collapse followed the same pattern. Easy credit, speculation, asset bubbles, overconfidence, then panic, housing, stocks, .com, subprime, crypto, commercial real estate. Different names, same mechanism, money created too easily, chasing returns, inflating prices, disconnecting from reality until confidence breaks. And when confidence breaks, everything moves at once. People rush to sell, banks tighten, credit disappears, markets crash, and suddenly, the same institutions that created the mess become too big to fail. They are rescued, they are protected, they are stabilized with more money, created from nothing. Again, losses are absorbed by the public through inflation, through taxes, through austerity, through lost opportunity. You pay, quietly, over time, without a headline. This is why every generation feels poorer, not because people became lazy, not because values declined, because the system eats the future to survive today. Debt is future labor, borrowing is future sacrifice. Stimulus is future inflation, rescues are future inequality. Every solution borrows from tomorrow, and tomorrow always arrives, with interest. Think about national debt, trillions. Numbers so large they no longer feel real. But they are real. They represent promises, promises that someone must honor. And that someone is usually not the people who made them. It is the people who come later. You, your children, your grandchildren, they inherit obligations they never approved, in a system they never designed, with rules they never voted on. That is why instability is becoming normal. Permanent crisis, permanent emergency, permanent intervention, permanent uncertainty. The system cannot rest. Because resting would expose its weakness. It must always be doing something. Printing, cutting rates, raising rates, stimulating, restricting, constant motion, like a bicycle that falls if it stops. And the faster it goes, the harder it is to control. At some point, every debt-based system reaches a limit, not suddenly, gradually, growth slows, returns shrink, risk rises, trust weakens, people notice, investors become cautious, banks become nervous, governments become desperate, and desperate systems make dangerous decisions. They manipulate data, they change definitions, they hide losses, they rewrite rules, not to fix the problem, to survive one more cycle, one more year, one more election, one more quarter, one more bonus. Meanwhile, the foundation keeps weakening, and ordinary people feel it first. Job insecurity, housing stress, credit tightening, higher costs, lower mobility. The pressure moves downward, always, because power flows upward and risk flows down. This is not pessimism, it is mathematics. It is what happens when money is created as debt, without natural limits, without accountability, without real consequences for failure. Eventually, reality pushes back. And when it does, it is never gentle. So, what does all of this mean for you? Not in theory, not in textbooks, not in headlines. In real life, it means you are living inside a system that quietly transfers risk onto you, while protecting the people closest to money creation. When things go well, they profit. When things go badly, you absorb the damage through inflation, through layoffs, through lost savings, through higher taxes, through weaker currency. You are the shock absorber. And most people never realize it. They think, I just need to earn more. I just need to save more. I just need to invest better. But no amount of discipline can fully protect you from structural dilution. When new money is constantly created, your existing money becomes less powerful, every year, silently, like water leaking from a bucket with no visible hole. You do not wake up one day broke. You wake up one day confused. Why does my money not go as far? Why am I always catching up? Why does stability feel temporary? Why does security feel fragile? That confusion is a feature, not a bug. If you understood exactly what was happening, you would stop trusting easy promises. You would stop believing official narratives. You would stop expecting systems to protect you. And systems do not want independent thinkers. They want predictable participants. That is why financial language is complicated, why policies are buried in documents, why central bank decisions sound technical, why economic debates feel inaccessible. Complexity discourages curiosity, and confusion creates compliance. Most people assume someone smarter than me is handling this. Experts know what they are doing. They would not let things collapse. But experts work inside incentives. They respond to pressure. They protect institutions. They preserve stability today, even if it destroys stability tomorrow. Because tomorrow is someone else's problem. And over time, this creates a strange reality where everyone knows something is wrong, but nobody feels responsible. Governments blame markets. Markets blame consumers. Banks blame borrowers. Borrowers blame themselves. The circle closes, and the structure survives. Think about how often crises are described. Unforeseeable, unexpected, once in a lifetime. Yet they happen every decade, sometimes faster. That is not bad luck. That is design stress. A system stretched beyond its limits again and again and again. You are taught to plan your life, save, invest, retire, protect. But you are planning on shifting ground, on policies that change, on currencies that weaken, on rules that evolve, on systems that prioritize themselves. So your plans constantly need revision. Your goals constantly move. Your finish line constantly shifts. This creates exhaustion, decision fatigue, anxiety, short-term thinking. And when people are tired, they accept less, they question less, they demand less, they settle. That is how slow decline works, not through collapse, through adaptation. People adapt to worse conditions, then call them normal, then defend them, then forget anything else existed, and the system counts on that